Today we have an exciting conversation with Josh Campbell. He is the commercial real estate appraiser for Wise County Appraisal District. He has 10 years of experience, and he's also in charge of training and education. So Josh, thanks for joining us today.
Glad to be here.
Awesome. So I think first off, our first question would just be if you could give us a general explanation of the appraisal process that the county goes through for real estate.
If you don't mind, I'm going to talk about, because appraisal process is actually part of the tax cycle. It's a 4-stage process, and I think that's important for taxpayers and property owners to know that. So the first phase is obviously the appraisal phase, and that's kind of where we collect data and things like that. Technically, that starts at January 1 and it lasts until May 15th, but because there's so much ground to cover, there's so much new construction in the county, we really have to start collecting data in August. So we start, looking at visiting properties, looking for new improvements have been taken away. We start asking information from businesses about what kind of rents and stuff they use, and just researching on all that kind of data process. So that's getting all the information so that we can accurately appraise stuff. And then comes the equalization phase. That's probably the process that most taxpayers are most familiar with. That's the protest process.
Okay.
And that begins like May 15th to July 20th, and that's where people file protests and come before the board and make their cases and things like that. So appraisal, equalization, assessment, which is where they decide what the tax rates are, and then those tax rates get applied to the values.
Okay.
And then they collect the taxes. Those are the 4 phases.
Okay.
Okay.
Good.
And the collection phase, you said usually begins sometime from October through January 31st.
October 1st, when they send the bill out, as soon as you get your bill, it's paid. It's payable. And then you have until January 31st to pay without penalty.
Okay.
Afterwards, you can pay it. There are taxes and penalties that are associated with that. So if you can't pay it, I would definitely contact the tax office and see if there's a payment plan you can work out. I mean, the sooner you can do that, the better off you are. So we've already gone through the appraisal phase for 24. Yes.
So you already have all of these are the properties we're going to tax, and these are the improvements we're going to tax. That is finished at May 15th.
Yeah, so the notices that people received in May 15th or in that area of 24 were for the bills that they're paying now, which is part of the assessment phase. So it's always kind of a year in advance, or a year behind or whatever. So we have to go through that process. And so the bills that they get in October of that tax year are for January 1 of the preceding tax year, right? So it's not for January 2025, but January of 2024.
Okay, so we will begin again January 1 to May 15th. We'll look at all the properties, and we'll look at all the improvements, and then we'll get a notice again in May, and we'll pay that tax the following December.
That's correct. Yeah, I mean, we are probably also still currently in our collection of data phase, in the appraisal phase right now, because there's so much work to do. We do a little bit of that before January 1. But January 1, according to the property tax code, is the date of appraisal, right? So whatever the condition is of the property as of January 1 is what you get taxed on. Let's say your house was incomplete as of January 1, because there's a lot of new construction going on. So if your house is 50% complete January 1, 2025, then your bill will reflect that 50% completion value. Likewise, if your house in January 2024 was only half complete this year, it's probably done. So you can expect to pay the full value on that after your exemption.
So on January 1, if it's just raw land, but then by the house is fully built in 2 months, you're only paying tax on that land.
That's
for
correct.
That year.
That is correct. It's a double-edged sword, because the flip side is if your house burns down in February, which is a tragedy, because January 1 is the date of appraisal, you still have to pay taxes on it. So that's one of the things. I mean, we get that a lot. Disaster strike. We've had tornadoes hit, and houses have been demolished. And unless the governor does some sort of crisis management or what disaster relief is what I'm looking for.
Right.
Then there's no relief for that, unfortunately, written in the tax code. And that's where step 2 is the equalization.
Equalization.
Phase. That's right. So the people file their protests. They come before the board, they make their cases, things like that. And what y'all probably don't realize is taxing entities can actually challenge our values as well. That doesn't happen very often, but it can if they don't think we value the properties high enough.
Oh.
Because I doubt that they'll value it if it's too low, right? I mean, you know, I mean, if they think it's not high, yeah. Anyway, so so that's part of that process. That bleeds into what we're doing now because, you know, I mentioned, or I should have mentioned that these phases kind of overlap. Like I said, we're collecting data now, even though technically we're in the assessment phase, but we still have protests that will get carried over from the summer if we don't get to hear them all, rescheduled, things like that. And we're also, at this point in time, because people are getting their tax bills, we get a lot of people who call and talk about it because obviously, you know, either they missed their notice of appraised value or they didn't get a chance to protest. So now they're looking at their tax bill and going, whoa, that's a lot. And so there's another avenue that they have. If they did not file a protest in the summer, didn't get any remedy, that they can file what is called a motion to correct 1/3 or 1/4 for homestead. And so that happens during this time period too, which is still technically part of the equalization phase, but it happens because of the assessment phase, which is, again, the phase we're in now. Your taxpayers, you know, got their bills in October, and they are due upon receipt, but you have until January 31st to pay them without penalty.
Okay, so if you didn't file your protest by the deadline, which was
May 15th or 30 days. So sometimes we re-notice folks, like something happens, so they have 30 days from the date of that receipt.
Okay.
But May 15th is a typical deadline.
Okay, and then if they didn't file that protest, there is one more opportunity to file a protest, but you need to be undervalued by...
Overvalued.
Or, I'm sorry, overvalued by...
A third for people who don't have homestead exemption. So commercial property, you know, rental property, things like that, is 1/3 over. And for homestead, they've recently remedied that to make it 1/4 over. Okay. So a quick equation for that is if you are a homesteader, if you multiply your market value, not your assessed, but your market, by 80%, if you feel like your property is worth that or under, you've got a case. For the 1/3 over, if you multiply your market value by 75%, and it's at or below that, you think that value is there or below, then you've got a case.
Then how long do you have to file that second?
Deadline is January 31st.
Okay.
Yeah.
So up until the time the taxes really due without penalty.
That's right.
And for residential homeowners, 9 times out of 10, that's in escrow, so that's getting paid usually in December.
As soon as the mortgage companies get the bill, I'm sure they're, you know, as long as you've got the money in your escrow to pay it, they're going to send the check to it as soon as they can. Typically, a good mortgage company is not going to make you late.
Yeah.
Right.
Let's put it that way. So, yeah.
If you don't have a homestead exemption, so if you have a homestead exemption, that's residential real estate, and if you don't have one, that's commercial real estate?
No.
Okay.
The homestead exemption is for residential property, but you can own residential property and not be your homestead.
Okay.
You have folks who have, you know, live in the city but have property on Lake Bridgeport, right? It's not commercial property; it's still residential, but you can only apply a homestead on your primary residence in Texas.
So, if you have a rental property, that would be appraised as commercial property?
No. Residential property is typically residential property. Just because you get rent on it, again, we're talking house, right? Mm-hmm. Because what really makes the distinction between commercial and residential is really what is its highest and best use, right? That's a term we throw about a lot.
Right.
So commercial property is typically going to be office. It's going to be industrial. It's going to be, you know, income producing. That is typically income producing. That's pretty much the main use of it. But a rental home, that's not necessarily the best use of it, right? Mm-hmm. Especially when we're in a housing shortage like we are. We have so many housing subdivisions going on. That the highest and best use of a residential house is probably to a homeowner, right? So it does not become commercial just because you can income. In fact, the income approach to value, because there's 3 approaches to value, can be applied to residential property too. It doesn't necessarily make it commercial, but it is an approach to value. There's 3 approaches: market, cost, and income. So those can be applied typically to any type of valuation, but there are some that is the best method. Mostly for a residential property, we're going to look at market because we have a robust market. We can look at those sales, we can analyze it, we can kind of get an idea of what properties are selling for.
So is it up to the county which method they use? If they say market is lower than income approach, Can they use the income approach?
Again, we're gonna probably use what the best property is for that particular. And USPAP and IWO have standards. Like they say, there's like a range. It says, and sometimes it's like these two are on the same level, but sometimes it's this, and this. Typically, for residential property, the best method is market. If you don't have a market, then you have to rely on cost or income, typically. So let's say we had no market data for residential property, and we noticed that, on residential properties, people were leasing it for a lot, and it would be hard to know whether they were transferring for more unless we had sales. But if, all things considered, we looked at these properties that were residential that homeowners were buying and applying, and they were selling for less than income-producing residential properties. So we might have to look at it from that perspective. But so far, I haven't seen that.
So if you had a short-term rental, say out at Lake Bridgeport,
sure,
and you've got a short-term rental property, and it's paying the hotel tax.
Okay.
So then you would assume that's commercial property, right?
You kind of, when you say short-term, you're talking Airbnb kind of things, right?
Yes. So less than 30 days.
Sure.
So you're paying the hotel tax.
And until we can get data to tell us that's going to influence the data. So the question becomes, does an Airbnb, a property that's used for that purpose, sell for more than a property that is not used for that purpose? If it's relatively the same, and we have market sales, like Lake Bridgeport is a great example. We have sales for lakefront property. Even when the lake is low, the property has always sold for more than we have it appraised. It's a constant battle for us to value these properties because they sell for so much more. We're like, what are we missing? That may be because they're Airbnbs. I don't know. But where do we get that data from? So we can't just make suppositions about properties. Unless we know that it's an Airbnb, unless there's distinct stuff, unless it's showing up on some sort of book that we can look at, we can't make that assumption. We have to assume that it's exchanging hands for that. And there's enough of a market that values. I mean, lakefront property is lakefront property, and it typically sells for more. And I don't think it matters whether it's short-term or not. Now, a person who is going to sell that property based upon the short-term income may still arrive at a similar value, right? But they're just approaching it a different way. That's why we say income and market. So typically, when a fee appraisal does an appraisal, or when we do that, we have to reconcile our approaches to value back to the market.
Is it up to the county then, whether they use the income approach or the market approach, whichever is higher?
Whatever reflects the market better. And because if the income approach reveals a higher value, but the properties aren't selling for that, then we can't use the income approach, right? We have to use the market approach. But what if the
income approach gave you a lower value than the market? Who makes that determination? Are you able to charge market value? Because if it's a short-term rental, it's paying hotel tax, it's being taxed, as a hotel.
Okay.
So who makes that determination? The
determination is made by the property tax code, because we have to value property at 100% market value. So whatever that is what we value it at. So that's what makes a determination. If market value is sales approach, then that's what we use. If the market value is the income approach, then that's what we would use if it's relevant. So it's not like we're going to decide which one we like better. It's what does the market reflect?
Okay.
Right? It's not like we're going to, and our goal is never to let's get it as high as we can. I know that that's a conception, but that's not it. It's what would it sell for on the market? That is 100% our goal.
All right. So first question is, generally speaking, what factors cause the values for commercial properties to either increase or decrease?
Okay, great question. So keep in mind that market value is our goal, right? So whatever the market is going to determine are the factors that are involved. And it's a lot the same in some respects as residential. A lot of the factors that it would change a residential property would impact a commercial property. So those things are like location. If you can have an undesirable location that's going to affect the value. So if you have a property here and a property here, and this property is kind of in a downturn economic area, it may sell for less than a property in an up-and-coming hot market. Condition, if a storm came by and hit your property, or you got water leaks, or any number of conditions may apply.
Okay.
That would affect market value. The market itself, right? If the market takes a downturn and properties are selling for less around January 1, that's going to impact the value of the property. So those are downturns. But then again, sometimes those things can change. So say if some place was formerly in an undesirable location, that may change. The market may be gentrified. It may be getting more attention, and people are. Bridgeport's a great example. Downtown Bridgeport for a while was ghost town, and now it's you've got all kinds of cool things going on down there. So it was undesirable. Now it's worth more because the market has been
right.
So Josh, why did we see that big increase in 2023 in the appraised values for commercial properties?
The primary difference between 2022 and 2023 is we actually did see some sales data for industrial type properties and offices and things like that, and we were 40% under what these properties were selling for, which is huge. So we had to ask ourselves, what is it that we're missing? So we went to Marshall & Swift, which is a national recognized cost estimate company, and we looked at their schedules for commercial properties and saw that we were low compared to these cost estimates. And so we applied those costs, to our values, and lo and behold, that got us 101% or something. So much closer to market value than what we noticed. In fact, we looked at these things and saw that our income approach, based upon the data we had, wasn't getting there. On these especially industrial properties. I mean, they were selling for ridiculous amounts of money. And it had, they were vacant. They weren't buying new leases. I mean, it was puzzling, to be honest. So the major jump then, to answer your question in the short answer, is that there was sales activity that showed that we were undervaluing properties, and we applied an updated cost schedule to correct that value.
Okay, so when you apply the updated cost schedule, then the cost values go up?
Yes. So what we found was income wasn't reconciling back to market. Our sales activity was high, so we had to figure out, okay, so what are we missing? Why are our schedules not getting there? Because we typically use, for the most part, on residential and commercial properties, a blend of sales approach and cost approach, right? We look at what things are selling for, what are our schedules, and we tweak our schedules a little bit. And it's a lot easier to do on residential properties, but it's a lot harder to do on commercial, because there's typically not a lot of sales activity in our area. That has changed. I don't know if y'all are aware of this, but we're part of the Dallas-Fort Worth MSA.
Yes.
Which is the fourth largest in the nation and the fastest growing in the nation. So there's going to be more sales activity here now, not just for residential, but for commercial as well. So sales values are, again, with commercial properties, there's typically not a lot of sales activity.
Right.
Right. So it's hard for us to know the gaps. And we have updated our schedule. We've used Marshall & Swift for years, but we haven't updated our commercial schedules much in the past years, because that would raise our value significantly, as we saw.
Right.
Right. So we were like, okay, I don't think that's our market. That's not what our market is, because for years, there hasn't been it's been hard to evaluate commercial property in Wise County. It's been low for years and years and years, and it's recently gone up because we've seen upticks in markets and things like that. So what happened was our sales, we had properties selling for more than we had them appraised. So we had to go, what is it that we're missing, right? So what we could have done is go, well, let's just put a market adjustment on all these properties. But when you talk about a 40% market adjustment on properties, that's hard to swallow, right? So we looked at what other components we might be missing so that we didn't have to artificially inflate properties to meet that market value. So we looked at our costs and realized we hadn't updated these schedules in a while based upon Marshall & Swift, based upon what it was doing in cost schedules. So once we applied those, we tested it and said, oh, okay, that's what we're missing.
So it sounds like that big jump we saw was because once you evaluated replacement costs, that value was so much higher.
We still depreciate them.
And we weren't picking that up with our market value because we just had a limited number of sales.
So what you probably have seen in that 40% jump was a lack of raising values over several years.
Okay.
And we were catching up.
There's no cap on that.
Not a market value. That's correct. Now that they have changed the the legislation came in and did that circuit breaker. So now we're talking about 2 different values in commercial properties as well now.
Okay.
So it's always, there's never been on residential or commercial a cap on market value. Never, never, never. Because the goal is always 100%.
Right.
But thankfully, now it would have been more beneficial if they had done it in 22 or 23.
So I'm wondering about the timing of now we're going to raise these values and then we come in after the fact and do the circuit. So that's helpful, but it would have been
probably
a
a
lot
response
more
to
helpful.
it, honestly.
It would have been a lot more helpful
for sure
in 2022.
I don't disagree with that, and it's one of those kind of things. For our perspective, it was a difficult trigger to pull because we knew it was a big increase. But I don't know if y'all realize this or not, but we also are graded by the state. The comptroller sends out someone every 2 years to test our values. It's called a property value study. And so they look at our values versus what market data is suggesting. And if we fail that study 2 years in a row, school districts can lose funding. Every other year, they send people out to evaluate our methods and procedures. It's called the MAP study. So 1 year they look at our values, and the other year they look at how we actually do our jobs. And so 2023 also happened to be a property value study year. So that was kind of an unfortunate complex of events, right?
Have we ever failed that?
I don't know that we have ever failed like that in a while. I think there was 1 year that Boyd was out of margin, but we corrected it next year. It was no problem. I don't know that any of our school districts have ever lost funding that I'm aware of. Mickey Hand was our former chief appraiser. He'd done it for a couple of decades, almost as long as Monty has done that, and he did a really good job making sure. I mean, passing maps is and PBS is a big deal.
So we've always been able to pass that.
We have, but we have never had market activity for them to look at, and then we did.
Okay.
Right? So that kind of was like, oh, if they come in and they pull those sales and they look at these properties and we didn't make a change, we would have failed that study for sure.
Interesting. So earlier you mentioned that, if your property has a water leak or some of the improvements have declined, sure, or there's a tornado that came through or something,
right,
the value could potentially drop.
Yes.
Now, are there any steps that a homeowner, for example, or a business owner could do to be proactive and let you guys know ahead of time,
sure,
hey, this and this have happened, I believe my value's decreased, before they get to that phase of protest?
Right. So what I would say is, if you know that your property has a condition that's going to be January 1, and it was still the problem as of January 1, then we let your appraiser know, whether it's residential or commercial. If you have problems that we have to consider, then we absolutely want to do that. And you don't have to wait till the protest process to do that. In fact, it's probably easier. So if you have conditions as of January 1, I think one of the best things you can do is invite your appraiser out to come take a look at it. You do not have to wait until protest season, although you can if you want to. I mean, that's absolutely a remedy you have. But when we can see it around the 1st of January, that's the date of appraisal. So January 1 is the date of appraisal. So getting us to look at that around the 1st is probably best. I will say, too, that if you know that you have issues around the 1st, the best remedy for those things is an estimate to cure the problem. Pictures work, but they don't always tell us what the value, what it's going to cost.
Right.
So having that available to us, very, very beneficial for the taxpayer. Especially because if you wait till protest season, there's a limited time to get that stuff to us. So if you start on that early enough, get that to us before we send out appraisal notices, then you're good with the value. We discuss what we're going to do, and you're good with that. You don't have to worry about protesting it.
So is there some value in, waiting to improve the property until after January 1st, and then potentially you can use that invoice on the repair cost as support as to, the fact that there was this condition at that time?
So let's talk about improvement versus cost to cure. One of the things that I do get occasionally from people are upgrade estimates. But that's not what we're asking for.
Right.
Because that's going to increase your effective year and things like that. That's going to increase your market value. It's not necessarily, because we hope that our effective year and effective age kind of evaluation kind of catches the age and the quality of the property. So I'm going to put in marble cabinets and doing that later. That's not going to help us. You added value for 25. You didn't subtract value for 24.
Right.
But if my pipes are busted, and I didn't get them fixed until mid-January. My roof is severely damaged, and I couldn't do it until I got my tax return. Those things matter.
So any kind of impairment
Sure.
that might decrease the value of residential or commercial property below market value
Right.
that happened before January 1st,
you didn't correct it.
And you didn't correct it. You want notification of that and an estimate on how to correct that before those values goes out. That's going to be the most efficient way to do that.
Absolutely. You have more time to do it that way. Because if we file a protest, if you file a protest and we say, oh, you have conditions, we'll get us some cost secure. Well, then you have to scramble to get someone to do it and find someone who's going to get out there enough time. And you can reschedule your protest, but I mean, you only have a couple of times that you can do that without providing like sufficient notice. So it's better to get it done on the beginning side for sure.
And how early could you start that process?
If you know that you are going to have conditions that you're not going to fix in the fall, and you can't get it done by January 1, call us.
Okay.
The worst case scenario, you let us know too early, and we're like, okay, well, is it going to be done as of January 1? We'll code your account to follow up with it around the 1st and find out.
Okay.
So once you get to that protest point, what would be the steps to take to protest and file that protest after the value has been determined, and what supporting documentation would be best to have for that?
So typically, if your value increases by 1,000 or more, we'll send you out a notice of appraised value. So if your market value increased, you'll get a notice and you can file a protest based upon that, because typically those notices actually have a protest form on the back of it.
Right.
There's also some verbiage on the page that will help you file a protest online if you're eligible for that. Agents still don't have that capacity yet because it'll overwhelm our system. We can't take it, but your regular taxpayer can do that. If you don't get a notice of appraised value, you can come into the district and get a form. You can call our ARB coordinator and see if she can set you up with an online way to file a protest that way. We also have forms online. If you go to wise-cad.com, at the top of the page there's a forms. Click on that, and it'll take you to a page with a bunch of different forms. And no protest form is on there, so that's available to taxpayers. So you can. There's multiple ways to do that, or if you don't want to go to our website, you can always Google it. It's a PDF online. So
okay. And so, can you just explain a little bit about the income approach to assessing appraised value?
Sure. We right now there's a few properties that we primarily use from the get-go income approach, and that's going to be mini warehouses, mobile home RV parks, of course, hotel motels. There's a multiplier with that. So those are typically the ones that we start. Flex buildings too. We're starting to get some data in for flex industrial. So we're starting to use that approach to value from the get-go there as well. So that essentially the way to calculate a value from using the income approach is you take and there's more than one income approach to value. I'm going to use the one we most commonly use, which is the capitalization rate process. You take your annual rent and you multiply it by your square footage, and that gives you your potential gross income. And then you minus out vacancy and collection. So typically in industries that's going to be somewhere between 10 to 15%. And that allows for people not renting the property or not collecting it. And so we'll subtract that from your potential gross income, and that gets us our effective gross income. And then from there, we apply your expenses, right? So typically, depending upon the industry, you're going to see somewhere between 10 to 45 to 50% expenses, depending upon the industry, what type it is, whether it's a triple net lease or not. And so there, we subtract that out of the effective gross income. That comes our net operating income, or NOI. And then from there, you divide that number by the capitalization rate. Depending upon the type of property. Let's say, for example, it's a triple net lease. We're not going to load the cap rate with the tax rate. Or if we include the taxes and the expense, we're not going to load the tax rate. But if we don't do that, if we don't load, if we don't put the taxes into the expense, and it is not a triple net, we'll load the tax rate as well. So we divide that number, and that's going to arrive at our indicated value.
And how do you come up with the cap rate?
Research. We'll look at CoStar's place that we get our cap rates from. There's all kinds of market information. I do a lot of Googling. There's all kinds of some websites out there. Boulder Group has cap rates. So we're going to try to look at our MSA at the most. If we can find tax rates specifically for Wise County, we're obviously going to use those because that applies to our market. But if we are struggling to find specific for our county, we'll go to our MSA. But we won't ever go beyond that.
So are you applying the same cap rate across the board to all commercial properties in Wise County?
Cap rates vary by type, right?
Okay.
So office cap rates are going to be different than industrial cap rates. Mobile home park cap rates are going to be different. I mean, because it depends on the type of property, the amount of risk that's involved. We've done some income evaluations on post offices. Usually during the protest season, we kind of use that to support our value. But those cap rates tend to be really low because it's a pretty safe investment. So
so what would a range of cap rates be?
Wow. It could vary by quite a bit, depending upon different things. I've seen cap rates as low as 5% and as high as 10%. But they tend to be lower here than some of the national averages because of our market is right. So robust.
So who determines that cap rate? Is that your determination, or do the commercial property owners bring you a cap rate?
We send out market data letters. Now, a cap rate is a particular owner is not going to be someone who this is the cap rate I know, but they may put some numbers to it. Like we have a local property owner who typically does pretty good income workups, and for his offices, and he'll send that in as evidence for a protest, and we'll use that as okay, that's what they're saying, that's local. Typically, they match back up to other stuff that we've looked at. But yeah, we'll look at CoStar. We'll examine sales. So when we have a sale price and income, right, that's part of that process, we can derive a cap rate from that.
Okay, so if I value a property using the income approach, and maybe I've had a lot of vacancy, so my income approach valuation is low,
right?
But market value is still high, you're going to take that market value anyway?
We're mass appraisal, so I definitely have to say that. So typically on the income approach, IAAO and USPAP says market data, right? So if your property, let's say you have a property, for whatever reason, your vacancy and your expenses are higher than normal, right? We would have to look at, if we have data that says, okay, well, typically your type of property is going to have these kind of vacancy, this kind of market, and we've got data to support that. We kind of have to question, like, what is it about your particular property that's causing that to be lower? Would an investor who's calculating whether they're going to buy that property going to use your expenses or what they think their expenses are going to be to calculate it? And that's typically what we find to be true. They're going to use market data, and that's, again, because that's what they're going to buy and sell for, what they market data usually. There may be something specific about your property.
Maybe you had a flood, or there was a reason
100%, right? And rental rates, like if your property is in we talked about undesirable locations earlier. So if your property is in a more undesirable location, you're going to probably charge less rent. If you have conditions to your property, but it's kind of run down or whatever, it's an old building or whatever, you may not intend to fix it, but you're going to charge less rent, right? So those things are part of the income approach and absolutely matter.
All right, so what is the 23.231 exemption?
Okay. So that is an interesting thing that came about this year. Previously, homestead properties were the only ones that had any kind of cap, right? So the circuit breaker limitation is basically a 20% cap. Just like the homestead cap is 10%, this is 20%. Right. In order to qualify for it, you have to own the property on the preceding January 1 and the following January 1, right? So if I bought a property in May, I'm not going to qualify for the circuit breaker for 25. that make sense?
Right. And that circuit breaker is going to cap the gain. So the gain in appraised
The assessed value. The assessed value.
Or,
yeah. Because there's a
difference between assessed and appraised?
Depends on what you mean by appraised. If appraised and assessed typically can be synonymous, but like assessed is essentially what you're taxed on. Your taxable value and assessed value are the same.
Okay, so with that circuit breaker, we can only increase a commercial property's assessed value by 20%.
By 20%, unless you build new value into it.
Okay,
right?
And so if you build new value, do we still have to put that 20% cap on the old value and then just add the new value, or is everything off? I could go up 40% because I did a 10% improvement.
Right.
Can I go up 40%? I'm starting all over again.
Right. So let's talk about new value. Let's say my property was worth $100,000 last year.
Right.
And I built on an addition that was $40,000. Okay. And then market values increased another $20,000. So we're now without my addition, property be worth, well, let's say 130. So because otherwise it wouldn't cap anything. So let's say market values raised my $100,000 value to $130,000, and then I added $40,000 new improvement. Right. So $20,000 from the cap is going to go into the assessed value, and then $10,000 of that is going to go into the circuit breaker limitation line. And then my new value of $40,000 is going to go in there. So my taxes would increase by that $160,000.
So the circuit breaker still helps on the old appraised value.
100%.
Still keeps that old appraised value from going up, but I'm going to pay whatever the
new value
market value is. Okay.
Right. Now, you talked earlier about how one of those things, how can we benefit, talking about conditions and what, if you build something new, that's another thing that you can be proactive about. Like, hey, it cost me X amount of dollars to build this, right? Because we're going to make assumptions based upon market data, upon cost schedules and things like that. So, if maybe the exterior quality is better, but the interior quality is not as good, and we can't see that unless you show us. We don't know. Mm-hmm. We spent $30,000 this instead of 10 because we don't have these kind of things on the inside of it. Let us know.
For 2025, are commercial appraised values expected to increase, decrease, and by what percentage?
Okay, that's a good question. I wish I could break out my crystal ball and tell you an exact answer, but I can't. We are still analyzing data. There's a lot of market activity that happens in the last quarter of the year. So we need that before we can make an accurate assessment. And we also will look at some sales just after the first, because that's also a pretty clear indication of market, right? So we need all that data before we can make an accurate assessment. We do know that there are some pockets in the area that we might have to look at our land. We haven't adjusted land schedules in a while. We know that we're probably too low, so we'll probably have to look at those. But again, we've got to analyze that data first. I can say that we did not increase much from 24 to 25. Right, I'm sorry, from 23 to 24, the market plateau, which we were eternally grateful for. And we haven't yet seen an overall increase yet. So again, if there's going to be an increase, it will be pocket areas and not overall.
I want to circle back to short-term rentals. And earlier you said that my understanding is they're paying a hotel tax, right? But most likely they're actually being appraised as though they're residential because that's going to be the best comp for sales to get to the market value. Is that right?
Right. Highest and best use is always a question we have to ask in appraisal property. So if you had a market that was saturated with sales of properties that were selling one home buyer to another home buyer, and your property fits that description, again, because most of these short-term rentals we're talking about are actually residential properties that are used to drive income. If the highest and best use of that property is to sell it to someone who's going to buy it as a house and live in it, and because we're in a housing shortage, then that's probably the way it's going to be appraised, is what's the highest and best use of it. Because even though someone were to use it as an investment, well, I don't know if that's the best return for my investment, it doesn't mean that you couldn't turn around and still sell it at the market value we've got it appraised at, which is what we're ultimately concerned with.
So we were talking about which cap rates, if we were going to bring you a commercial income approached valuation on our commercial property, which cap rates would you recommend in Wise County? Where do we go to find a cap rate that you would consider?
So not everybody's going to pay for CoStar. So I would be my first go-to is go to CoStar. But it costs to do that. But you can do some research online. Dallas Fort Worth MSA, office cap rates, medical office cap rates, industrial cap rates, apartment cap rates. I mean, there's all kinds of information out there, and I'm a big fan of AI. I use it quite a bit. There's a new thing out there called Perplexity AI. You can actually ask your question on that website, and it will actually give you sources. So if you're not very good at Googling, but you want those sources, you can say, what are the market data for this type of property in the DFW, and it'll give you a list, and you can look at the resources for it. It's pretty cool.
Okay, perfect.
Nice. Do you know if the state of Texas offers any tax assistance or exemptions to commercial taxpayers in addition to what we've spoken about already?
Man, as far as I know, the only remedy for commercial property is that circuit breaker. And again, that only applies for properties that are $5 million or less. So that's something to consider as well.
Okay.
Yeah, no, there's no exemptions that you can. But the good news is you don't have to apply for that circuit breaker.
Right.
Whereas with a homestead, you have to apply for it.
So most commercial property owners in Wise County, if their valuation has gone up more than 20%, they'll see that on their appraised value for the taxes that are due.
That's right.
Now.
That's right. And that includes, let's say you successfully protested your property in a preceding year, okay? And that value has not gone up, right? Then your cap is going to come into play, right? So if you reduced your property value by 30% or more through protesting it, and that value has come off, and that value is capped.
Does property tax reset if it transfers owners? So, for example, someone passes away and they inherit a property. How is that reassessed?
So it won't happen the tax year of. I like examples. It's kind of the way if I was over 65 and I own the property as of January 1 of 2025. And I die in February. My wife has already gone, let's say, and my kids are inheriting that property. Well, my kids will still reap the benefit of that exemption for 2025 because it was in place as of January 1.
Okay.
But for the next year, it's coming off.
Right. And is the entire value reassessed at that point, that next cycle?
We can reappraise property every 2 years. So the market value has gone up. So keep in mind that's not going to be affected. But what will affect people is if there was a significant cap, that will automatically go down to the taxable value. And the over 65 exemption will be removed, which means a lot of times those freezes come with a freeze on tax rates.
Right.
And a homestead exemption might be removed too, right?
Absolutely. If you're a new owner and you buy something that has agricultural exemption, if you don't reapply for it, you lose it.
Right.
So anything you have to apply for will. And the commercial property, if you buy a property in February, of 24, in 2025, you're not going to get the benefit of the circuit breaker limitation. And if there was value held in that circuit breaker limitation it's going to go into the taxable value.
So you would see a significant increase in that case.
The last couple questions really would just be, what questions have we not asked? What questions are you most frequently asked at your office by taxpayers?
A lot of times they ask, like y'all have asked, what do we do to protest? What documentation do we need? Am I eligible for this particular exemption? We get that a lot. What do I need to bring in? I don't know that there's anything that I can think of off the top of my head that they have asked that you haven't covered. Y'all been very thorough.
Well, great. And any advice that you would have for a commercial or even a residential taxpayer? In your situation, if you were in their shoes, what would you do?
Okay, great. I will say that if you're a new home buyer, make sure that you file for your homestead. It doesn't come out. And one of the things I've run into with taxpayers before is they thought that when they closed on their house, that document was filled out, and it's not.
Mm-hmm. Right.
You have to apply for that. And I bought my house in Alvord in 2008. I had no idea any of this stuff. So I sat without a homestead exemption for, I don't know, 3 or 4 years until someone said, you should do that. So I went in. So it doesn't happen automatically. You have to do that. So make sure you file for your homestead. If you have agricultural, if you bought a property that had an ag exemption, make sure that you file for it, because just because it had it doesn't mean it carries over. Make sure that you do that.
And with the homestead exemption, if you realize, oh no, I forgot to file,
it goes back.
It goes back how many years?
I think it's 2.
2
It used to be 5, but I think they made it 2.
And what about the agricultural exemption?
So the rule is you have to have ag for 5 out of 7 years. So if you, let's say you bought your property in 2024, that exemption popped off for 25, and you forgot to apply for 25. You'll notice that when you get your notice of appraised value in, for sure. You can late file. April 15th is a deadline for ag, but if you don't file by the time we certify, you're not getting it for that year. Just doesn't happen.
And you can't go back and
go back retroactively. No.
Okay.
So, but if you filed in 26 because you had history, you should be okay. But if you 25, 26, and then forgot one more year, you're going to have to build history again.
And it's got to be 5 out of 7 years.
Right, and that's not. We used to think it was okay. 1, 2, 3, 4, 5. We can give it to you. No, 6 year.
Okay.
So it's important that you make sure you.
Yeah, it's a significant exemption.
Yes, it really is. So other advice I would tell you is, call your appraiser if you have questions. I know there's this whole joke about, I'm from the government, I'm here to help. But we really do want taxpayers to understand. And we don't know everything. I mean, you're going to catch me on tape saying this, but we do make mistakes, right? There are things that we miss. We don't know what the inside of your property looks like. If you don't tell us, we don't know. Because we're mass appraisal, we have to make assumptions. We just have to. So if there's something specific about your property that we can't see from the outside, you got to let us know. And like we've talked about earlier, you don't have to wait until protest season to do that.
On commercial property, you're comparing sales in the area. What's the area for Wise County?
We definitely want to try to concentrate as much as Wise County as we can. But let's say we have a bunch of properties in Northwest ISD, which is a very hot market, right? We're not going to say that a property, even if it's identical in Northwest, is going to sell the same as like Chico, right?
Right.
The markets are vastly different. Okay, so we analyze commercial and real and residential on a scale. It's always neighborhood, school district, Wise County.
And if there are no sales comps for a specific type of property, and the reason I say commercial is that would be more likely.
Yes.
To not have commercial sales comps, then you're going to look at cost replacement.
Cost replacement. And again, like mini warehouses and things like that, it's pretty much the income approach on that. Because one of the things that I run across is people who, you bought it in 25 and you're concerned what taxes you're going to pay. And I would recommend, because I'm a believer in capital costs, if you buy a property for a certain amount of dollars, you should definitely kind of figure out, based upon last year's tax rates, what can I potentially expect to pay? And I think that's something that people should do. Realtors don't like me saying that because they may back out of a property because they realize the taxes are too much. Because the problem is that people look at, say if you bought a property that's over 65, you think that's what you're going to pay, and that's not necessarily the case. So it's always better to kind of go, I bought my property for X amount of dollars, let's apply the tax rate to that. Even you may get the benefit of an exemption, may get the benefit of a cap, but knowing what you can potentially pay and making an informed decision when you purchase it is probably a good thing to do.
Right.
Yeah, definitely.
And there's no guarantee if you got a great deal on a property that you can multiply that great deal times the tax rate, and that's what you'll pay. They're still going to mark it up to what you should have paid.
Yeah, if that great deal is the market, then yeah. But if it's, you bought it from your brother, maybe not.
Right.
So if that's the case, you got a great deal on their property, it was in horrible condition, so that they don't mark it up to market value, you need to bring photos. And remember, January 1's the day. So if you bought it in August and we had to buy January 1, don't expect to. Right. But you bought it in December, it's in terrible condition.
And you haven't fixed it yet? Absolutely. Okay. Hey, here's why it costs less. I've seen so many people when they're protest because of that. And it's hard for me to advocate against that. I'm like, it is what it is, you know?
So maybe you would bring photos and estimates on what it will cost to repair and bring it up to.
Sure. If you don't bring it to us, if you wait till protest season, bring it to the panel. But yeah, I mean, if there's a rationale behind why you got it for less.
Okay, so a lot of times we will see somebody buys a property. It's in terrible conditions. Maybe they're going to do a remodel on it. Maybe they bought it in December. They haven't repaired it by January. The appraisal district, if you don't notify them, is still going to value it. Even maybe you paid $200, they're going to value it at $250, $300, because that's what all the houses in the neighborhood are selling for. If that's the case, you need to get in there. And what type of documentation would you want to use to support why you paid a lower price and why it should be valued? The appraised value should be a lower price.
Okay. You would want to bring in your pictures of the property showing, like, hey, the conditions on the inside didn't reflect the outside, or we're going to rehab this, and here is what it's going to cost. And again, cost to cure, not cost to improve, but yes. So
I bought a house that was 20 years old. I've got to take all the carpet, all the appliances. Is that rehab or is that improvement?
So if the reason why you bought it for less is because it was in that condition, and I think that's an argument that you could make.
Okay. And the most effective way to do that is make that argument before you get that appraised value.
If you can. And in the worst case scenario, if you can't come to an agreement with your appraiser, file a protest.
Okay. So. And if you filed a protest, any idea what percentage of those protests that actually go to the appraisal review board, what percentage would you say are successful protests?
Boy, I really could not answer that question.
Okay.
I do know that if you come in, let me put it this way. I've rarely seen a taxpayer come in with sufficient evidence to prove that there's condition and not get a reduction.
Okay.
Right? I mean, that's rarely the case. The only time I've ever seen that is because they came in and that wasn't conditioned as of January 1. Right? That's about the only time I've ever seen that. Or they fixed it before January 1, one of those two things. But if that's a condition as of January 1, the board's going to rule in your favor typically. And honestly, if you file a protest and you can get us that estimates beforehand, I mean, you know, we don't want to go before the board for something silly like that. We'd rather settle it if we can. So.
And you can submit that evidence online as well.
Yep. And if you check informal, that's another thing we didn't talk about for the appraisal process or for the protest process. If you want an appraiser to contact you before your hearing, check the informal box. We are required by law to meet with you with informal. Now, that informal process may be an email or a phone call, not necessarily in person, but we'll contact you. We'll say, hey, what do you got? You know, what is it that you think affects your value? But again, as we've talked about, if there's conditions, it's better to get that to us beforehand.
Right. So the big thing is the difference between an improvement versus...
Right. So like if your carpet has holes in it,
right,
or it's ratty or your walls have holes in them, not like, you know what, I want to put a new splash of paint and I don't like that carpet. That's not the same.
Right.
And there is the argument too, and I've seen this as well, where we may have an effective year higher than what that property, because we don't know what the inside is, because we look at what properties have sold for,
right, and
updating the effective year is a way to kind of help us manage those values. But there are occasions where, again, because we're master appraisal, there's maybe this house hasn't been updated in 20 years.
Right.
Here's proof.
So what would be a good cutoff? If I can say, well, my house has not been improved in 10 years. Do I need to go 10 years, 15 years, 20 years?
You feel like is valid, bring it, right? I can't say for certain one way or another, you know, because if we haven't updated the effective year much, like if we have an effective year of 1995 and you haven't updated in 10 years, we're probably okay. Mm-hmm. But if we have your effective year of 2010 and the house is the same as it was in 1995, then that's a valid argument.
And where would we find that effective year?
If you go online, I believe you can see it on your website. It'll have like effective year, mm-hmm, and it'll show that on there. Or you can always call and ask us for your appraisal card. We'll send it to you.
Well, Josh, thanks so much for coming in. This was great info. I'm sure our listeners are going to learn a lot. I know I did. If you found today's video helpful, please give us a thumbs up, consider subscribing and leaving a comment below. And as always, thanks so much for tuning in.